Good evening, everyone. Welcome to Admiral Markets webinar of 22nd of May 2014. Today we will have a webinar about trading multiple pairs and why trading 20 or more multiple pairs is crucial. Also, Chris is with me and he will be joining later. So let me explain first the risks associated with Forex market and then we can continue. So, online educational materials are developed by Admiral Markets AS Estonia for a global audience. Therefore, please take into consideration that information in this session may not be suitable for everyone. To get a corresponding information on charting conditions and any other detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Also, read disclosure statement stating all the possible risks associated with Forex market, and by accepting the risk, you're also agreeing to proceed further with me. Admiral Market UK Ltd takes no responsibility for the information accuracy. The analysis represents the personal opinion of the author, me and Chris, and in no way it represents the actual suggestion for the trade. These are not AMUK's opinions, and the website in the video is not the .co.uk website, but the globalnews.com website. Forex is risky business. This is a personal opinion only, and this webinar is for informational and educational purposes only. So we can start our webinar about trading multiple pairs and why that is beneficial to you. So first of all, you need to know that currencies divide on majors, minors, and exotics. So basically, we have major pairs, we have minor pairs, and we have exotic pairs. For all of you who don't know, the currency to the left is called the base currency. So let us have an example of, let's say, euro-dollar. So euro, because it's to the left, it's base currency. The currency to the right, in this case dollar, is called the quote, the currency. It's quoted currency. So we have base currency and we have quote currency. So the base currency is the basis for the buy or the sell trade. So euro dollar, so the base currency is euro. GBP dollar, the base currency is GBP. So basically we have that correlation, base currency and quote. Major currency pairs all contain US dollar on one side, so either on the base side or the quote side. So major currency pairs, you remember, they all have dollar on one side, okay? Either on the base or the quote. Euro dollar, GBP dollar, dollar Swissy, Australian dollar, dollar, so they all contain your US dollar. Most frequently traded pair in the Forex market are major crosses. So most frequently traded pairs are major crosses because the majors generally have the lowest spread and are the most liquid ones. Euro-dollar is the most traded pair, making 30% of overall volume. So remember that. At the first place we have major crosses, then we have minor crosses, and we have exotic crosses. So that is concerning major crosses. So major currency pairs all contain US dollar on one side. That is very important for you to know if you didn't know it prior to this webinar. Minor crosses are also called cross-currency pairs. So cross-currency pairs or minor currency pairs are called minor crosses. Some time ago in let's say early history, we had indirect exchange rates. What it means, basically, we had one currency which needed to be converted in US dollars and then finally to desired currency. So that was I cannot say late history, but it was an early history before we had basically ECN spreads, great executions, and before we had even direct exchange rates. So indirect exchange rates, we all needed to convert a currency into US dollar and then into desired currency. So with employing direct exchange rates, we have also the ability to basically trade cross-currency pairs or minor crosses with good spreads. So the most active crosses are derived from three major non-US dollar currencies: Euro, Pound, and Yen. So three major non-US dollar currencies, Euro, Pound, and Yen, make up for minor crosses. And finally, we have exotic crosses. Exotic currency pairs are made up of a major currency pair paired with the currency of an emerging economy. So those are exotic currency pairs. So they are made up of a major currency pair paired with the currency of an emerging economy. These pairs are not traded as often as the majors or minors. Because of that, the cost of trading is higher. We have bigger spreads. We have it's hard to trade it, and because of that, we don't recommend trading exotic crosses because you have 20 and more currency pairs to trade, and why would you trade something which has big spreads, which is very uncertain, and which depends on many other factors? So basically, I don't recommend doing that. And basically, one example is, let's say, Euro, Swiss Kron, or other currency pairs, or Euro, Turkish Lira, and all other pairs which are not mentioned in minor and major crosses are just not suitable for a trade at the time being. So this is the table of major crosses, and we can see that all of those crosses have dollar either to the left side or to the right side. Either the dollar is base currency or quote currency. Euro dollar, dollar yen, sterling pound dollar, dollar Canadian dollar, dollar Swissy, dollar Australian dollar, then dollar, and New Zealand dollar, dollar. So all of those pairs, euro, yen, sterling pound, CAD, Swissy, Aussie, and Kiwi, have dollar either as a base currency to the left or to the right as a quote currency. Those are major crosses. Most popular of those major crosses are euro dollar, called fiber, then GBP dollar called cable, then dollar yen, then dollar Swiss franc called Swissy, and of course Australian dollar cross called Aussie. Also we have dollar CAD, which is also very much traded. It's called CAD, and New Zealand dollar, which is also known as Kiwi. So basically these are all major crosses, and most popular are euro dollar, cable, Aussie, and dollar Swissy. Maybe we can say that the fourth place, maybe the third place, is dollar yen, because dollar Swissy is just it's almost the same as you're trading counter of euro dollar, because really euro dollar and dollar Swiss have the biggest negative correlation. Basically, if you go long on euro dollar, it's the same as if you went short with dollar Swissy. So it basically is the same pair, just contra direction. Then we have minor crosses. As we said, minor crosses are called cross-currency pairs and are derived from three major non-US dollar currencies. Those are Euro GBP, Euro Swissy, Euro CAD, Euro Australian dollar, Euro New Zealand dollar, Euro yen, GBP yen, Swissy yen, CAD yen, Australian dollar yen, New Zealand yen, GBP Swissy, GBP Australian dollar, GBP CAD, and this is not included in the table, but I also trade Australian dollar New Zealand. So also Australian dollar New Zealand is concerned as a minor cross, and its volatility is great during Asian session. Okay, maybe the most volatile of these pairs, these pairs is Dragon. It's GBP yen. And I can say all GBP crosses are really very volatile. GBP Aussie, GBP Swissy, GBP CAD, they are very volatile. Also, Euro Australian dollar can be very volatile. It has a good correlation to Euro dollar, and if Euro dollar makes 30-50 pips, Euro Australian dollar will make double that amount. So basically, I like to trade all of those pairs, and I will show you my results. I will show you how Camarilla MACD went since the exception last 4 months, and basically I will show you which currency pairs I traded and why these currency pairs are great to trade. So why we should trade most of them, not just euro, dollar, or cable. This is pure beauty, and this is a great thing to have as your portfolio is getting diversified. And now we have exotic crosses. As I said, I don't recommend trading those just because volatility is thin sometimes it can be. We're not sure in the technical analysis of it. It's not so precise as minor and majors, and the biggest thing, the spread of these pairs can be very, very high. Why is that? It's because these pairs are not traded as often as the majors or minors. That is why the spread of these pairs can go sometimes more than 20-30 pips. So I don't recommend trading exotic crosses, but I do heartily recommend trading major and minor crosses, including Australian dollar, New Zealand dollar, which is not found in this table. Now, what is the advantage of trading multiple pairs? What is the advantage? Well, let's say that the advantage is, the first and big advantage is a lot more chances to get into a good trade. So that is why I really prefer it. It's a lot more chances to get into a good trade. And if you, let's say, trade only one pair, euro dollar, you don't know if euro dollar will indeed go as we plan it to go by our technical analysis, or it will be stuck in a range. There have been it has happened very often that we basically wanted to trade euro or cable, and we didn't have a good chance to trade just because the pair didn't move, or maybe just because those pairs were moved like 10 pips in one direction, then down, then 5 pips up, 7 pips down, 8 pips up, 10 pips down, 12 pips up, 15 pips down, and so on. So basically, you know, when you see that kind of price action, when you see that the currency pair is stuck in a range, then you need to switch to another pair. Because if GBP dollar is making a price action something like this, the GBP Aussie may move like this, or euro dollar may move like this, or Australian dollar, New Zealand may move like this, giving us potentially good trades. Now, if your trading style is technically based, but only this, if your trading style is technically based, you may find success over different pairs. So you need to be a technical trader. You need to have a good system which is tradable on multiple currency pairs. Because if you open the chart, you can easily see which pairs are moving well. If euro dollar is not moving well, if Australian dollar is not moving well, if GBP is not moving well, why isn't good to pick it, let's say, GBP yen, Swiss yen, CAD yen, or maybe Euro CAD? Maybe some of those pairs, even if they are related or correlated to some extent, you will have a bigger chance to spot a good trending pair and well-moving pair than a range-bound pair, because you have 24 pairs at your disposal. That means that you are basically diversifying your portfolio management. Now, imagine that as Bollinger Bands, and imagine that you trade only 1, 2, 3 pairs, 4 pairs. Bollinger Band may look like this. And now imagine that you have a good system and good method, and you are trading 24 pairs. 24 pairs will indeed widen up your Bollinger Bands and probably give you good chance for your portfolio to rise and your profits to get even better. That is the law of nature. That is the law of Forex trading. Why not trade 20 pairs with 2, 1, 2, 3 eventually pip spread, then only 2 pairs with 0.5 or 1 pip spread? 1 pip will not make a difference, but 20 pairs more will make a difference. Contrary to many opinions on the internet, in my case, I can guarantee that the method which I use for trading, which I have developed, gave me more pips and more money with less drawdown than trading only euro-dollar. And I was maybe the most famous of all Forex Factory traders on euro-dollar trade back in time, because I was trading euro-dollar as a single currency pair. I was trading euro-dollar at the beginning. That was the only currency pair which I was actively trading. I even didn't want to take a look on another pair. I can say now from this perspective that the way I traded then and the way I trade now, there is a big difference in it. And the difference is averagely, I get into bigger profits with a lesser drawdown. Even though if those profits may not be so big, my aim is to make 2 to 10% per month, eventually 2 to 5% per month, not losing more than 3-4% per month. Even if I make it up like this, and I'm not making 20% as 12% as I made in the year of 2009, 2012 and 2011 and maybe in 2009, but I can count that as basically it was those were lucky trades because euro dollar was going short and all you need is to pick up the level and go short. So basically that was other kind of trading. It doesn't have anything to do with this day trade, with trading as it is today. So basically what I can say is maybe the profits are not so huge. I'm getting anywhere from 2 to 5% or to eventually to 10% per month. But the thing is, I have more chances to trade and I'm not stuck with a single strategy. Back in time I used intraday. I was making maybe 1 or 2 trades per day only on euro dollar. And that was very good because euro dollar was going short. All you needed to do is wait for retracement, pick up retracement, and then go short. It was very easy. It was, that is science fiction. It won't happen anyway anytime soon, and that is good because the trading is not just shorting it, longing it. We need to be able to trade in both directions. Scalping, intraday trading, intra-week trading, breakout trading, not just shorting or longing. So by trading multiple pairs, you will diversify your portfolio. If you know what you're doing, you will make bigger profits and better profits per month because you can easily see which pairs are moving well. You will not be stuck in a range. If euro dollar is ranging, if cable is ranging, if all of majors mostly are ranging, why not move to Swiss yen? and see if that pair is ranging. If it's in a trend, it's easy because you can always pick up a trend. And also a good advantage, a big advantage to that is you will guys have more engagement with trading. So you will be more engaged with trading, and that will give you better understanding of currency flow. So you won't be just glued to look euro, dollar, or cable. There is no such thing as professional euro dollar trader or professional GBP dollar trader. You're either a trader or not. There is no professional. I just hate when I read there was a common thing on Forex Factory. I am a GBP dollar professional trader, or I am a dollar Swiss professional trader. There is no professional trader trading only one pair. You can be a trader trading one or two pairs, but you cannot say I'm a professional euro dollar trader, because if you know to trade euro dollar, you will know how to trade Euro Aussie, you will know how to trade Australian dollar, you will know how to trade Swissy, you will know how to trade all correlated pairs to euro dollar. So there is no such thing as professional euro dollar trader. You either want to trade 2 pairs or 22 pairs. You need to choose. If you want to trade 22 pairs, you have a good chance to become a fully fledged professional analyst and trader. I would be most embarrassed if a person comes to me and say, okay, Nenad, try to do GBP Aussie analysis, or try to do CAD Yen analysis. And what would I say? Imagine me saying I don't know how to do that. That is stupid. I would never let myself to, I would not never let it allow. I would not never allow myself to say that I don't know. If I don't know how to trade something, I would say I don't know how to trade euro, Turkish lira, or dollar, South African rand, or Hong Kong dollar, because I never traded it. And I don't recommend trading it. But it's probably more or less the same, but the spreads are bigger. But if someone asks me, okay, make me a chart for anything of these pairs, including Aussie, New Zealand, I would say no problem. It's not a problem for me. Even these currency pairs, I can do analysis of it. But the training is not just about making an analysis. I can do a good analysis of euro Turkish lira. If euro lira is correlated to euro dollar, it's very easy for me to do the analysis. But if the spread is 15 pips, I wouldn't trade it, because on euro dollar spread is 2.5 pips, and it's much more tradable than euro Turkish lira. It's not that I cannot do it. I can make analysis, but I cannot give you a good recommendation. Make stop loss. If spread is 15 pips, you need to counter that into a stop loss. I can give you advice. Okay, you can go with that pair, but you need to go with margin trading. You need to go with equity trading. You need to use that full margin to trade it, because the pair may go up, may go down. It's not very tradable. So basically, you will be doing a margin trade. With this kind of trading, I do technical trades. The biggest majority and the great majority of my trades, almost 95% of them, are using the stop loss not more than 30 pips. 90% of my trades are having 30 pip stop loss, because my method works that way. And by doing proper analysis and engagement with trading all of those pairs, I will have better understanding, and I have better understanding of currency flow. You also will get better fundamental reasoning, because if you trade all of these pairs, you need to pay attention to fundamentals. You need to know when other correlated pair, or where that currency quote, a base quote of quoted quote, is basically having a news. If we trade CAD yen, we would concentrate on both CAD and Japan news. If we trade New Zealand yen, we would trade it normally in Asia session, but we would be concentrating more on New Zealand and Japanese yen news. Then we can do basket trading. We can open simultaneously couple of pairs. If euro dollar, euro Australian dollar, euro dollar, GBP dollar, and let's say New Zealand dollar are moving in the same direction, we can basically make a little bit of exposure to dollar and open more pairs because they are moving in the same direction. But if euro dollar is moving 20, 30, 50 pips, cable will probably move higher, and it will move probably more than 50 pips, and euro dollar will surely make more than 50 pips because it's more volatile, and ATR of euro dollar is bigger. Cable yen also. They're very, very volatile pairs. And trading multiple sessions. By trading more than one currency, you will be able, I'm not saying that you need to do that, but you will be able to trade multiple sessions. So let's say that you're maybe not available, you're not free on London session, you have other things to do. Just let's say that you're not close to your platform. That means that if you're trading only one pair, that means that you will be probably trading next day. But you want to trade. Why not be late for Asia session and try to trade Australian dollar yen, New Zealand yen, CAD yen, Swiss yen, GBP Aussie? Why not trade that? Because if you're not available in one session, you will probably be available at the other session. But you need to know that how to trade multiple pairs. And you need to let go that fear of trading only one or two pairs. I know that most wise traders are focused on trading euro dollar or two pairs. I can guarantee you, if you are constant enough, you will let your fear go away from you, and you will be available to trade multiple pairs. Because probably is the fear of unknown that is stopping you from trying to trade other pairs than euro, dollar, or cable. And now we have two problems of trading multiple pairs. No experience. If you don't have any experience in trading multiple pairs, well, that is a problem. That is me and Chris, why we always advise you on free webinars, or if we are mentors to someone, we always advise try first euro dollar, and then if you're successful with it, try demo trading other pairs. Because the method which we teach you, even on paid or free webinars, it doesn't matter, usually we come up with a good method which can be traded on more currency pairs, multiple currency pairs. So we always advise you to trade multiple currency pairs, not just one currency pair. You will gain experience. Believe me, it's okay. Maybe not in the first 6 months, but after we encourage you to try to trade other currency pairs. But if you want to trade it, you need to know the system. Which system is good for a currency pair? Is that system good for New Zealand yen? Or is that system good for all of these pairs? You need to know that. Because many systems which are marketed, which are being marketed across the internet are pure snake oil. They will give you only one or two pairs to trade, and probably it won't be they're not so successful. So basically you are stuck. Then volatility. For most of you, volatility can be a problem because many of those pairs are very volatile. Australian dollar yen, New Zealand yen on Asia session can be very volatile. GBP yen is extremely volatile. Also GBP Aussie, also Euro Aussie. So volatility can be a barrier which you need to overcome in order to trade multiple pairs. Then currency correlation. We talked about currency correlation, and if you remember currency correlation, all of those currencies are correlated somehow. If you decide to open long on euro dollar but also short on GBP Aussie, look, if you need to look on currency correlation. If those currencies are correlated more than plus 80 or minus 80, then you need either to close the position or to be prepared for a potentially double the profit if the trade goes in your direction. If euro dollar is going long, but if GBP Aussie is negatively correlated to euro dollar, then probably one of your trades will be successful, but the other trade will be negative. Now the pair which is more volatile will have the bigger impact. If euro dollar makes 30 pips in positive direction, but GBP Aussie will probably make 50 pips. So 30 against 50. You need to know where your stop is, and you need to know always, always, always whether those two pairs which you trade or more pairs simultaneously are correlated and how are they correlated. I always check correlation before I make multiple entries. Then there is double exposure. Let's say buying two correlated dollar pairs. If you buy euro dollar and you buy GBP dollar, it can be advantage. But if you don't have a proper method and a proper system, it can be a disadvantage, because you will be double exposed to dollar currency and dollar index. Then multiple pairs can possibly overtrade you. They can give you more chances to trade, but maybe if you are not stable as a trader, you will be probably over trading. And we come to the final point. It's a risk management. Risk management is something that you need to work on if you want to trade multiple currency pairs. And I did the header of this slide is named problems of trading multiple pairs. I did that intentionally because I didn't want to make it as disadvantages, because for me there is no disadvantage of trading multiple pairs. There are only problems which you can overcome if you carefully listen to what we are trying to explain on this webinar. Okay? Now, this is an example of today's correlation on 1 hour chart. So you can see that GBP, Aussie, and Australian dollar are negatively correlated on hourly chart. If Aussie is going up, GBP Aussie will go down. More than plus 70, 80, and more than, let's say that more, if the currency pair is going more than minus 70 or minus 80, they are negatively correlated. More than plus 80, they are positively correlated. In between, the pairs are moving so-so. So we can see that euro dollar and euro GBP are going 85% in the same direction today. But to GBP Swissy, it's minus 80, so they are moving oppositely. Always pay attention to tables. They are crucial if you want to trade multiple pairs. And also, what I want to say, that can be advantage and or disadvantage. It's called hedging. With trading multiple pairs, you can do a hedging technique. A hedging method is one that encourages trading in the opposite direction of the initial trade without having to close that initial trade. And now we are not referring to first in, first out or FIFO rule, which affects only US citizens. We are talking about European, Asian, and other continental traders, not US traders. So that is hedging. And basically, if you hedge as a trader, you can close the initial trade and enter the market at a better price. So the advantage of using a hedge technique is that you can keep your trade live in the market and bank additional profit with a second trade, which banks additional profit as the market moves against the first position. Experienced forex traders often take hedge trades versus a particular currency by using two different currency pairs. For example, you could go long on euro-dollar and short a dollar-Swissie pair. In that instance, traders would be hedging their dollar exposure by pairing the dollar versus the volatility of both euro and Swiss franc. So basically, the hedging is also one of techniques and advantages of trading multiple pairs. Now, for requirements for trading those pairs, you need to have a good and proven method. So if you have a mentor, your mentor will tell you whether you can trade with that method or not, whether you can trade multiple currency pairs or not. Also, he will probably, if you bought a system over the internet or if you listen to our webinars, we always say, we tested it on that and that currency pair. If you want to trade it another currency pair, test it. So good and proven method is first requirement. Then you need to know different trading styles. Intraday trading, breakout trading, scalping, counter trend trading. You need to be prepared for usage of trailing stop because most of those pairs are very volatile, and if you want to have profit, you need to use trailing stop. That is how I do at least. Intraday trading requires babysitting the trade. So if you trade intraday, many of those pairs can be opened simultaneously using correlation, using risk management, and you need to babysit the trade. You need to use trailing stop. You need to babysit the risk, the trade. You need to pay attention to fundamentals, and you need to know the fundamentals. If Australian news and bank rate will be high, there will be probably Australian dollar, Euro yen, New Zealand dollar will jump because they are correlated to Australian dollar and to news affecting Australian dollar. So knowing the fundamentals. Staying awake, you need to stay awake if you want to trade multiple pairs. If you want to trade at Asia session and you want to trade London, well, it's hard, I know, but you need to stay awake. Then a good platform, of course, me and Chris always recommends Admiral Markets platform, good spread, tight spreads, excellent execution. Good platform is very, very, very sensitive. So you need to have, and I presume that most of you are traders with Admiral Markets and are trading with Admiral Markets. And we recommend low spread account because on Pro account on Admiral Markets, let's say GBP Aussie is having 3 pips spread, on maybe standard account there is 20 pips spread. So low spread account is suggested, warmly suggested. It's absolute necessity. And final 2 slides before I hand over to Chris. This is my statistics, and these are currencies which I traded on March, February, April, and May. So you can pay attention to these slides. These are all currency pairs which I traded last 4 months, February to May. You can see CAD yen, 4 trades, Swiss yen, 4 trades, Australian dollar, 11 trades, Australian Swiss 1 trade, Australian CAD 7 trades. So to the right side of the pair is the number which represents how many trades I opened in a single month of that particular currency pair. So you can see February GBP dollar 10, April I had all of those pairs. GBP was the winner, I think 16 times I opened GBP dollar. This is May, Euro dollar 3, GBP yen 3, GBP dollar again 11, Swiss yen 1, euro, Australian dollar. And these are my results. From February till May, 8.4% of a gain in 4 months time with maximum drawdown of 8%. That was maximum drawdown. And the only time I had a drawdown, it's April, because the last Friday of the April, I was in a surplus, I was in a positive, and I think I have, what happened is I carried the trade over the weekend, and that trade basically gave me a negative score for that month. But almost all the time during April, I was very positive. I also used a little bit of leverage. That is why I call always risk management. I used a little bit of leverage. But now, today, I'm also positive. So this statistic is more than 4%. So basically, from February till May, my equity is untouched. The drawdown is very small, and it's almost 9% of a gain. This is called a winning streak. And out of all those trades I have traded, I can say that most of them were successful. Even this month, I had more success with trades, but that single trade gave me some slight minus 3% because I used a little bit of leverage. But yet again, now it's 22nd of May, I made more than 4%, making up for the last month and keeping risk low. 20 currency pairs traded in February, 22 currency pairs traded in March, 17 pairs traded in April, 13 pairs traded in May. I was trading, of course, Camarilla MACD, trend scalps, breakout, and counter trend opportunities, keeping the risk very, very small. So guys, this was my presentation of multiple pair webinar. Now it's time for me to hand over to Chris. I hope you enjoyed, and if you have any questions, you can, of course, freely ask me. Chris, you can continue.
T, I was just curious, a quick question from my side. What was the trigger that kind of led you to increase your number of pairs?
The trigger,
was there a specific event?
Yeah, that was a specific event because I really didn't like how I traded last year, because I traded only euro, dollar, cable, and Aussie, and I was basically letting the market to do trading instead of me. Market was really good. Other markets were really good. Let's say Australian dollar yen, New Zealand dollar, GBP Aussie. They were just much better to trade than euro dollar. And I also I wasn't happy because euro dollar was stuck in a range, if you remember, for some 2 months, and I basically just got loss. I was in a loss trading euro dollar. Instead of making profits, I was in a loss. And that was the trigger when I said, okay, I will go with the method which I will develop and which will be able to trade 23, 24 pairs. Because if I see that euro dollar is not giving me good opportunities, I will move to Swiss yen. Why would I trade euro dollar? And that way, I'm making a very, very small drawdown, and profits are exponentially better.
Interesting. Great stuff. Great.
Yeah, thank you, Chris.
Great. Yeah, I totally agree. I think that especially in choppy markets like we've seen, I would say in general, maybe in this entire year, of course, we've had some good movements, but quite a rough, tough market, I would say in general. I think it gives a bit more opportunity to look at more pairs. I myself was in the past looking at, for instance, euro dollar, pound dollar, indeed, AUD USD, dollar Swiss dollar yen, euro yen, dollar CAD, about, so let's say 7 pairs, I think, in the past. I also have expanded that focus to about the same number as you have been describing, and I did that, I've been doing that now, I think since the beginning, maybe end 2012, beginning 2013, something like that. I think it has its advantages. One of those advantages here you can see right in front of you is you can choose a pair that has more space. So you can kind of like look at the ranges and say if there's some substantial and sufficient space to trade, you can find that easier if you shop around a bit indeed and look for a pair that has more volatility, has more differences between its daily highs and lows, has a bit more average true range, and thereby capitalize on that potential. Otherwise, if one of the disadvantages when I was purely only trading the pound dollar, even before when I was trading 7 pairs, before that, yeah, the disadvantage of basically being stuck with that pair kind of and having such a tight range really annoyed me at that point indeed, and that you don't have that disadvantage when you look at multiple pairs, and you can, as I said, look at space. Now this is the left example, is an example where we see tight range. The right example we see more space. Then obviously that we're looking at more interest at the one that has space. Also, you need to wait less long before an opportunity arises. That depends how you trade. If you're a discretionary trader, you just open a chart and you use all your techniques and tools and concepts, and I guess eventually you'll bump into an opportunity that you can be traded. If you have a bit more rigorous and more rules to your strategy, then you might be filtering out a lot of things, and if you only look at a couple of currency pairs, it could take a long wait before an opportunity arises. Sometimes that doesn't really matter. If you're looking at the chart, intraday trading, patiently waiting, sometimes that patience can dry up and it could create the effect of chasing the trade, which is definitely not good, and creates impatience, and we start to go into this losing spiral, in fact, right? Because then once we have a bad trade, we might get annoyed and we start revenge trading and all this bad stuff. So with getting an optimal balance between the opportunities we want and how fast we see them, how fast we can trade them, compared to what we expect and of course reality, having a balance in that is important to keep our mental focus and basically our mental and psychological balance when trading. So this would be another advantage of trading 20 pairs, for instance. Now 20 pairs, by the way, you don't have to right away start off with 20. You could gradually grow if you're used to looking at 3 pairs. Start off with 5 or go to 6, or find the balance that makes sense to you. Take it step by step, and after you feel comfortable with that, you can always go to 8, of course, by the way. Maybe Tarantula said it. I missed part of the webinar, so of course you can trade one strategy only, a fully master it inside out, right? That's the advantage. If you're trading one pair, most of the time you're using a combination of analysis, or you're using a combination of indicators and tools to come up with a trade that you can do right here, right now for that pair, right? It's a bit frustrating if you're looking at one pair and you're not trading it the whole day. It's possible, but most of the time we're going to be enticed to trade that pair that day or that swing trade that week. If we're trading multiple pairs, you are more able to focus fully on one strategy instead of combining all kinds of things, combining all kinds of elements. That means that if you fully focus on one strategy, you can master it inside out. The better we become in one strategy, the more proficient we become in mastering our advantage and our edge, and basically implementing that edge day in and day out. That's what it all boils down to. So another reason for that, we have deeper knowledge and experience, and as our experience grows, our edge increases as well. Reason number 4, when we have more pairs to look at, we can be a bit more critical of the setup. We don't have to be glad that we see a setup. If we are glad that we see a setup, it's highly difficult to be able to filter out and say, no, I'm not taking that. If you're looking at the charts and you're watching paint dry and you see a potential setup, you're going to be skewed to taking it. It's very difficult not to take it if you finally see a setup. Like, oh, yes, there is one. Thank you. and then saying, oh, nah, it doesn't really, no, it's not what I want. Very difficult. If you have many opportunities in a day, which you will have if you look at multiple pairs, then you can be more selective of the setups and be a bit more demanding and say, okay, this is just not a tad not set up correctly. I'd rather look a bit further, rather have this a bit more or that a bit more. You can be a bit more critical with your setups and use filters a bit more aggressively and with more confidence that you basically, the one you filtered out would not be the only chance of that day. Let's say you filtered out something and that setup worked well, in fact. You were disciplined. You said, okay, actually it doesn't really meet what I totally want, so I'll skip it. That one opportunity I'll skip. And at the end of the day, that was the only opportunity and it actually worked out well. Well, that's annoying as well. So both sides of the coin are there. If you take it and it doesn't work well, or if you don't take it and it does work well, that's the only opportunity. You're going to have annoyances potentially at the end of the day. Reason number 5 for trading so many. You are able to execute your strategy in the desired way sooner. Well, that's basically tying in, I guess, a bit to what I was saying already prior to that. More opportunities, your strategy is going to be activated sooner. You can focus on that strategy, and you don't need to adjust your strategy to create ops. What means is that you can follow your rules instead of breaking them. If you're basically adjusting your strategy to have more opportunities, what are we? We're rule breakers. Unfortunately, breaking the rules is very easy. Most likely, I think the number one reason for us breaking the rules so often is because it's easier to do so than follow the rules. So that means we should set up rules that we can follow, set up rules that make sense to us and fit our personality, fit our psychology, and match us. Very important to have that in harmony. If we don't have it, the path of least resistance means that we're going to break it. The path of resistance, you hear me talk about it more often. It's a term from Bill Williams. He talks about it. Price takes the path of least resistance when it goes as it goes. If it goes up or down, that is the path of least resistance. Just like the river going down the mountain, the river will choose the path of least resistance. It's not going to smack through a rock and say, boom, rock, go out of the way. No, it's going to bounce off it. That's the path of least resistance. And for Forex traders, when implementing their trading plan, if our trading plan is not in sync with our psychology, the path of least resistance is to break our trading plan. So when we break our trading plan and we beat ourselves up for it, take a step back and think about it. Is it really something that is our fault, or is it something that just isn't in line with our psychology? Right? So something to think about maybe. Reason number 6. You are able to match your strategy better with the market environment. If you're looking for one strategy, right, then you want to make sure that whatever that strategy is in sync with the market. Well, if you're only looking at a couple, there's a good chance that that will not be in sync, which means more waiting. Now, there's nothing wrong with waiting, but eventually waiting becomes boring, and waiting leads to impatience and all the difficulties as such. So by matching our strategy with the market environment, we're implementing the strategy basically correctly. Now, if we're looking at 20, and 10 of them we can kick out because it's really not what we're looking for, we can be sure or more secure that those are in sync. Right? Some markets are going to be trending, some are reversing, some are ranging. Neda did a great job of explaining how you can analyze the crosses to make a judgment. You have a more overall picture of what's going on in the market, and therefore have more feeling which pair could be the strongest, which can be the weakest. So you're able to catch an entry you're able to catch an entry easier within your desired trading times. That's good. We don't want to overtrade because that could be too demanding for us mentally. Maybe not at the very short term, but eventually in the long run, it's going to be too demanding to follow through with that. So you want to have a sustainable trading times. That's easier as well with trading that many pairs. If your trading strategy or whatever you use is only geared towards one pair. It might be so that it's working. I'm not saying that by definition all of those are not working, but it is a bit, I think the better strategies work across the board. Let me say it this way. I think those are more robust strategies and have more likelihood of continuing with a decent probability, with a good probability in a decent fashion throughout time than if the strategy is only intended for one pair. In that regard, if it's only intended for one pair, I have some doubts if it's really a structural strategy and a structural principle that has more robustness, basically, and is more in balance. And I would be scared for changing performances and also scared for curve fitting of data, for instance. Reason number 9. And this is something that Nana definitely already talked about a lot. You are aware of price movements in the entire Forex market. You got the bigger picture. You can see which pair could be strong, which pair could be the weaker one, and you can match those and understand which could be the better pair. Just because there's Aussie weakness in the market, for instance, doesn't mean that the Euro-Odd would be the best pair or the Odd USD would be the best pair. Just because Aussie weakness is there doesn't mean that any pair could be the better one. The Aussie could be maybe the best traded at that point in time against the Yen, CAD, and Swiss. Maybe those 3 are the better ones, and the others are just not that good because of the other cross correlations there. Those are moving the most. And if you then take the Euro-Odd, although the idea is good of trading the Euro-Odd to the upside to capitalize on odd weakness, in practical sense, it hardly maybe moves compared to the odd yen, which flies to the downside, for instance, right? So very important difference sometimes, and these currency crosses can make a huge, huge difference in how much you actually get out of that pair, how much the pair actually moves in your favor, and how quickly the pair moves in your favor. So that's a big difference. Now, if you have any doubts, you can always split the risk and take 2 pairs, and keep the one that's going well and get rid of the one that doesn't go well, right? Or hang in there and manage it, and if it takes too long, exit, and if it eventually does go, fine, you got 2 going your way. That's another way of approaching it. But the point is there could be tremendous differences in pairs, even if you're trying to capitalize on one of the currencies. And you can do this matchup, strongest against the weakest, a lot easier when you have a full idea of what's going on in the Forex market than if you just focus on one pair or a couple of pairs. So I think that's it. Some warnings still. Trading many pairs definitely has many advantages, but some warnings as well, as Ned was talking about. So maybe this is a couple maybe the same, but take it easy. As I said already, take it step by step. Basically, it's not a marathon. It's not a sprint. It's a marathon. The other way around. So if you're used to 2, I wouldn't suggest going to 20 tomorrow, but go to 4 or 5, right? Take it step by step, basically. If it's too much at once, go back, reduce it even. Maybe if you go from 2 to 10 and you find out it's confusing, go back. Keep the strategy simple, and that make sure that you can follow your own trading plan. Make sure that everything on your chart has a purpose. Make sure that everything on your chart, you know what to use, not just it's there because maybe it's interesting. I mean, if you're in a test phase, fine. If you're testing something, I don't want to discourage you from that. But if you're trading for real thing, then you want to use stuff that you have experience with and you know what to do with. Avoid over trading, avoid over risking. Be critical of the opportunities. And that's it. So to go back quickly to summarize those 9 things that were mentioned here, more space, more easier to spot space and trade the ones that are moving, that are volatile. You have to wait less long before opportunities arise. You can focus on one strategy and master it. You can filter out to be more selective because there are more opportunities, and you can therefore execute the strategy in the desired way and make sure that your strategy suits and fits with the market environment and your psychology. You're easier, you can catch opportunities quicker, and you don't have to be worried of some, strategy only fitted for one pair as well. and you're aware of the entire Forex market. So those are the main things, and it's exactly the top of the hour. So maybe if you have some questions about your experience, maybe you want to share your experiences. How many pairs do you usually analyze? That could be a good, interesting question. I think we can share the answer with everyone. Just to bounce about an easy answer, just have to type in a number. How many currency pairs do you typically analyze? It will be interesting to see what numbers we see. So it just takes 5 seconds to type in a number. Roughly, you can even say, you know, a ballpark figure: 8 to 10, 13 to 15, 1 to 2, 3 to 5, 7 to 9. How many pairs, how many currency pairs do you trade or analyze when looking at the charts? So type in a number, please. In the meantime, don't forget, next week we have webinars again. Learning Lab and Trading Lab, as always, here are the times. Still waiting for your answers. There's no right or wrong here, so don't be shy. We're not going to, it's not an exam, nor will you get a grade for that, so no stress with answering. Don't worry. Stress-free here. It's not entry. So how many pairs do you typically analyze? Come on, folks. Only 2 answers. We need a few more. Otherwise, I'm just talking to myself.
Yeah, indeed, we need more answers, and that is why we do those that analysis, which is not just purely based on euro-dollar. Because if we spot that there is a choppy market in euro-dollar and there is a choppy market in dollar-yen, then we will try to find the best setup for you, and that is what we strive to do. Each day, every day, different analysis. Today, it was GBP dollar and Australian dollar. Yesterday, it was, let's say, Euro, GBP, Euro, dollar. Tomorrow, there will be maybe Swiss yen. So basically, we are always trying to pick up the best pairs of the day where you can try to find your setups in accordance to our analysis. Yeah, it seems we got some answers, Chris, here.
Lau is saying, indeed, depending on the opportunities, that's indeed another way of doing that, but a more flexible approach. Vigantas is saying usually 8, but could be 8 to 12. Claudiu says 1 to 3. And Lau is also including commodities, by the way. And Goran says EU, but plans to analyze more than 20 on the 4-hour and daily chart. So, yeah, we got a bit of a mixture, I guess, from this wide variety we could have, from ranging from 1 to 20 plus. So seems to be representative indeed. Good. Well, take this info for however you would like, and maybe you indeed decide to increase the numbers, but that's up to you, of course, always. And we'll be back next week with one more webinar, same time, same place. No questions, I see. Here is an example of the tight spreads net I was mentioning already. So take a look at that. Don't forget, after the webinar, and Twitter and Facebook. And we can wrap it up. Have a great weekend too, and see you all soon.
Yes. Cheers. See you soon.